Now let's do the amortization entry. We know that we need to amortize 14, and in order to get that, basically what's happening with the amortization expense is we're saying this is our amortization of the investment. So we have amortized on our income statement an expense of 14 and decreased our investment in S of 14. But we want to know what specifically did that 14 come from. Remember that 20 of it was like a depreciation expense. 20 of it came from the $100 increase in our equipment right here. We've got this amount, and we're depreciating it an extra 20 every year for 5 years. And so let's jump over here and do that. Increase our operating expenses debit of 20, and our deferred tax amount, we are coming over here and saying deferred tax liability 30. I'm going to increase that by 6 every time. We're saying that we're going to use part of our deferred tax liability, and when we use a DTL, it starts as a credit balance on our balance sheet. If we do DTL using it for a certain amount, then we would have deferred tax benefit of a certain amount. That would be the journal entry that we would record. So knowing that, let's increase our deferred tax benefit. So it would be a positive number. Positive on the income statement would be like a revenue. So let's increase it 6. And does that balance? Yes, 14 plus 6 equals 20. So the amortization one is good. Now let's do the differential. What's left in the differential? Well, we know that 66 goes to goodwill. That doesn't ever change. And we know that we had been adding 100 in equipment, but we just decreased it by 20 with this depreciation expense. So let's only add 80. And then what happens to the deferred liability, the deferred tax liability? We had an increase of 30, but we just used 6 of it. We're only going to increase it 24. And for the investment in S, let's add to it and say I want to add the sum of this, and then subtract off 24. And that gives us our 426. Does that balance out? Yes, sir, it does. Now let's go ahead and add across for our consolidation. So instead of boring everyone on question number 7, watching me type in all of these answers right here, I just summed them all across. I was talking through it as I did it, and it was really boring, and it was just taking forever. So just add across. The only things that might be confusing is, remember, something like this, you want to just add down because it's net income. This 67 was made up of the sum of all its parts above it, and so here it makes the sense that the net income would be the sum of all the parts above it. If you really want to, if that confuses you to not sum across, you can do 67 plus 30 minus the debits of 50 plus the credits of 20, and that will give you 67. I don't recommend doing it that way because it will confuse you later, but that's one option. So summing all of them across, and this one is kind of the same. Retained earnings, you want to just grab the net income from above. Dividends, you can sum across. And retained earnings, ending balance, you're just going to grab over here because you already calculated it over here. And then all of these, you just sum across. And then for total assets and total liabilities, you add down. And then retained earnings, again, don't sum across because you have it up here. So those are a couple nuances that are a little bit weird in this worksheet. It's not set up perfectly, but that's kind of sufficient now, I think. So let's go on to question 8. Is that question? Yeah, it's question 8. For the statement of cash flows. Operating, we know that net income is how we start because this is the indirect method, I believe. Yes. Indirect method, we start with net income. Depreciation, this is the hardest one. It tells us that they purchased $20 worth of equipment and SALT purchased $35 worth of equipment. And we know that the beginning balance was 50. So here's our little equipment T-chart. I love T-charts. T-accounts, whatever you call them. In fact, I don't like them. They're helpful, but I always just waste time doing them. So $450 is what we start at, plus the $20 purchase, plus the $35 purchase. And then our ending balance was $430. How do we know that? It tells us right here. Consolidated amount is $430. Remember, this is an account for all of them. Anytime we do statement of cash flows with consolidations, Just use the consolidated numbers. Don't try to do it one and then do the other and then consolidate them because it gets really confusing. Just start with the consolidated column. And you've got 450 is what we began at. How do we know that? Well, it was on our consolidated amount before, right here, 430. Now we're at 430 again. That's weird. Oh, I think I looked at the wrong one. Haha, 450, then 430. See, these are the kinds of things that we all mess up on a test, and I left that in the video because it's true. So it starts with 450, ends with 430. We added these two as purchases. So what is the amount? And to save us on a little bit of time, I'm just going to tell you that it's 75 instead of having to calculate it. So $75 depreciation we're going to add back because that was not a cash expense. Increase in inventory, we have more now. And because we've increased it, we had to buy it. So it's a negative 20. Increase in AP, if our accounts payable goes up, that means that we didn't pay our suppliers, so we didn't have to pay that cash. So let's add that back in. A decrease in another liability. If our liabilities decrease, that means we did not have to pay the cash. Or sorry, if our liabilities decrease, that means we paid the cash or something like it in order to decrease the liability. So when liabilities go down, cash goes down. All of those adjustments, if you add them all up, equals this amount, and this is those two added together. Now, investing. What did we do? Well, we purchased equipment for $20 and $35, so that's an outflow of $55 total. Financing, we paid dividends of $30. How do we know that? It told us. So, negative 30 plus negative 55 plus positive 365 gives us a total of 280. So, 280 plus the beginning cash on our consolidated amount before we started with 125, that's right here. Jump over here, that's our beginning cash plus the changing cash, ba-doom, equals 405. Is that right? Yes, it is. So we are good. And this is supposed to say true or false. If I can spell false. Now it says true. Yay, so we got it right. That's the statement of cash flows. All right, guys, I'll be honest. This is the hardest part, and it's going to take a while. Comprehensive homework review problem. It's that awkward extra sheet of paper that Sister Larson handed out at the very end, or Sister Bud, or whoever you had. And it's that brownish, gold, yellow, orange, whatever color. And it starts with during 2002, Pepper recorded book income for before tax of $440. So let's just start with the required section down there. We'll come back to all that information in a little bit at the top. Required, prepare the tax provision for SALT. And it tells us that we're going to need to reconcile the book PP&E and tax basis PP&E amounts. So let's start there. Year 1 and year 2, let's go to SALT. I realize there's a lot on the screen. I'll try to kind of isolate it here a little bit. This is what we're talking about. SALT's book and SALT's tax. PP&E, we know that on, and I'm just going to kind of breeze through some of these ones that are not blue because they're given to us. Year 1, we started at 100, and tax we had solved for 8. That was way back here when we did this amount, 108. So we start with those. We made a purchase of 35, and that's given to us. We did not sell anything. That was given to us. And this part was given to us at the end. It was the book value of 110. So we can solve for the depreciation amount of 25. Now from there, and the given DTL, remember that they gave us at the end right over here, I think it was, where was it? I don't remember where. Here, $4 of the DTL. They gave that to us. So the DTL was 4, and the ending balance right here was 110. And where is that for SALT? Right here. So 110 and 4 is where we got those numbers. They're given to us. And how do we figure out the ending balance for SALT in tax? Well, if we had the 100, we took the DTL of 6, divided it by the tax rate of 30%. That gave us 20. We subtracted 20 from 100 to get 80. Likewise, we do 4 divided by 0.3, and that's like 13 point something weird, I think. Let me grab my calculator real quick just to make sure. 4 divided by 0.3 equals 13.333. And then we're going to subtract that from our 110. and that gives us 96.6666 all the way out. So we have now solved for our SALT tax ending balance in year 1, and we have all this other information. We can then solve for the tax depreciation. And the cool thing about that is if you take the difference right here of 18.3333 minus 25, that's a different, or you take the difference there, it's a difference of 6.666667. And that amount is important because that is the change in the DTL.